Are you struggling to invest in property this year and need help buying? Then you need to book in a consultation with Investors Dream and let us do the hard work for you. Don't fall victim to missing out on incredible deals like everyone else. Lock in a meeting today. Go to investorsdream.com.au and secure your financial freedom today.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi everyone, how you going? Thanks for joining us on the podcast today. Smack bang in a range of conversations right now with people working within property, supporting investors to help make more informed decisions. And it's quite a tough market to get a hold of right now and understand and appreciate so many moving factors. Where do I buy? Why do I buy? What's the purpose of that particular asset? How much do I pay for it? How do I negotiate? Who do I use to support? It is a myriad complications for property investors to actually make sense of this particular market, which is always a challenge in markets which are going north. And everyone talks about being a bull run in property right now, which just means for a lot of investors, a lot more uncertainty. And where I find a lot of property investors land is that it's all too complicated. I'm unsure. I don't know what to do. So therefore, I just won't invest right now. I don't want to invest in a boom market. So I really wanted to get into that today as a concept or a scenario or even a base philosophy as a property investor is when is the right time to invest? And if you're investing, if the right time to invest is you're able to do it in the middle of a property boom, should you actually capitalize on that or should you hold fire? Joining me in the studio virtually, Matt Lewison. He's Director, OpenCorp. Regular guest on the show. Matt, how you going, mate? You well?
Yeah, great, Phil. Good to be here and not have to share the conversation too much with Cam today. It's just you and I.
Yeah, we're better off, mate. It means we can get more into the numbers and
that's right.
and then drill down and know
I'll
it's
put you to sleep with the numbers. Yeah,
we can be very numbers orientated. But how's Cam getting on? You guys busy at the moment?
Yeah, very busy, and we're on different sides of the country. I'm up in Queensland, Cam's down in Melbourne, but stay in touch a lot. And yeah, it's obviously a big contrast in the property markets, but things pretty much in every capital city right now, it's quite an anomaly. Every capital city is booming and probably not a surprise when you kind of think about the drivers of what's pushing it. Obviously a lack of supply in some markets, but obviously low interest rates. And we talked last month about also just like the delays in getting stock to market, for instance, for a market like Melbourne, which was in lockdown for so long, and that's playing catch up. So yeah, it's amazing things happening around Australia right now and very good and interesting time to be part of the property market.
Yeah, absolutely. And I know we know your crew down there at OpenCorp or OpenCorp, not down there anymore. I'm talking about Melbourne, the crew at OpenCorp pretty well. And you've all sort of got a lot of commonality in your skills, but largely your role, Matt, is you're more of the numbers guy operating at the identification and sort of interpretation of macro and microeconomic factors and figures to help shape your investment decision-making. Now, to the sort of point of the start of the podcast was, and myself included, I get really confused by all the numbers. I just don't know what's going on sometimes. And if it's all too hard, I just go, I can't be bothered doing this right now. I'm happy to sit out and miss out and therefore not invest in this current property boom. Your ability to invest in any market is going to be driven by your ability to secure finance. And let's just put that aside for the moment. Let's just assume that you are finance ready and ready to go. Why you shouldn't wait out a property boom? A lot of people strategically will say, the best thing I ever did was not invest during a property boom. I invested before that boom happened. And then the flip side of that is that, you wait for the boom to run through and then at the end of every boom, you normally see a normalization of prices. And this boom is different in that all areas are driving forward. So there will be some places will come back after this boom takes place. So I'll capitalize on it then. Or do you get involved? Do you participate? How do you make those calls, mate?
Yes, it's a good one. And as you know, like my dad got me into property investing when I was 18 and my brother was 20. And he'd been in it for 10 years and we'd kind of seen him build his portfolio through, I guess, some difficult times, but also some boom times. So we got involved early, but I don't know a single person, I guess, around our family and extended family and friends who hasn't at some time in my life gone to my dad, for instance, Steve, and asked him for some advice initially around property investment. And that was kind of what helped us to get into it ourselves. But I actually remember quite a while ago, one of my cousins won the lottery or won a small chunk of the lottery with some of his work colleagues and had some money to invest. And he asked Steve whether he should get into the market. The market was quite hot at the time. Dad said, like I was always told, the best time to invest is as soon as you can afford to. It's like, you can afford to. And anyway, the individual decided not to because the market was booming. He wanted to wait because he had some other people in his ear saying, prices will come back soon. Just wait until prices come back. And he waited and prices went up another $100,000, which was about 25% at that point in time. And eventually he decided to get into the market because his sister was actually on his case saying, look, I want to get in. Why don't we just get in together? And they finally did, and they benefited for it. But he missed that $100,000 worth of growth because he waited. I guess that's one of those things where nobody's got a crystal ball. You don't know whether tomorrow there's going to be an outbreak of COVID or something else might come along. But when you look historically, statistically, you're more likely to miss out because prices go up than you are to have invested and see prices go down. And even if you do mistime the market slightly, historically, they don't go down as much as they go up over time. So
yeah, it reminds me of the quote and sort of connected. It's better to have loved and lost than have never loved at all, right? Which means that if you don't actually do something, you're never going to be able to have at least a positive or negative experience against it. But to that baseline philosophy for yours, Matt, and also maybe that's consistent across OpenCorp, is that when you can and you can afford to invest comfortably, you are finance ready, et cetera, but when you can afford to invest, you should invest. So irrespective of the market, get involved. Is that a baseline philosophy of yours?
Absolutely, if you can afford to. And that's, I guess, the million-dollar question is not just can you afford to, but also where do you invest? Because part of the investment strategy, this is why people don't realize that an investment strategy is unique for every single investor. Somebody who has a borrowing capacity of $1 million may be buying in a different market as somebody with the borrowing capacity of $500,000. And maybe you could buy in this, for instance, you might be able to buy a property for $500,000 in Sydney, whether it's one of the, I guess, preferred properties that's going to go up in value and achieve the yield that you want over time and allow you to duplicate your portfolio over time versus a $500,000 property in Perth, for instance, or in Brisbane may open up different doors for your wealth to accumulate faster in the years to come. And normally we use a MAP process, market area property, which means we look at the market that we want to invest in first, then we look at the area within that market, and then we look specifically for the right property. And normally we would be looking at, to use I know a lot in the industry call it the property clock. We use it the development activity chain, which looks at where in the cycle of development and supply coming to market are we. And normally there's a few markets that are kind of in the do not buy kind of category because they've maybe had a boom and it's run its course and it just needs to stagnate for a little while, whereas others haven't seen that price growth. Now we've all of the markets are running hot at the same time right now, which is a bit different to normal. So the next thing we look at is that affordability. Like, where do we actually want to be for affordability? Yields are substantially better in Perth right now and substantially better in Brisbane than they are in Melbourne. So even though Melbourne's prices are running hot, the market is very different than it is in other states. So I guess that's one of the other things is looking at not just buying in your own neck of the woods, but perhaps even thinking more broadly of going, all right, based on what I can afford, or what market could I be in right now, and will that help me to achieve my goals?
So let's just drill into the MAP process, MAP process. So finding a good investment, smart investment when property markets are booming. So is this the mechanics of decision-making that you use at OpenCorp to work out whether or not a region, a suburb, a particular asset is a good investment versus one that might be a great investment?
Yeah, and we're very risk averse. So you obviously mentioned earlier that I'm kind of like the numbers man for the business, and some within the company would say I'm the risk guy. Like, I'm constantly thinking about risk. And the way we structured our portfolio, and again, if I use the things that my dad said, the one-liners were property doubles every 7 to 10 years. That's great. And historically, you can see that that's true, but I wanted to know why. And if you said, all right, well, is that every property? Because theoretically, some of them are going to do better than that, and some of them are going to do worse. So if you can just remove all of the options that are going to do worse, you're automatically going to do better than that 7 to 10 years for doubling. And then there's obviously that other component I mentioned about being able to duplicate, which comes down to your cash flow, which is impacted by the rent you get and relative to what you've paid. So we're really trying to eliminate as much risk as we can. And we do that by ruling out, first of all, states or cities if we can. And then once we've focused on the cities we can afford to be in, we then rule out which areas of this city do we not want to be because we're worried about supply coming through, or there might be a glut of properties already there, or the rents aren't there and the earnings for families in that area aren't going to support higher rents anytime soon, to leave us with a smaller pool of suburbs and areas that we think all right, we don't even have to get the absolute best property now. We're already playing above the averages because we've narrowed it down to this small selection. And then we obviously go for what's the best that we can in that small catchment.
Yeah, I guess the analogy of if you're a fisherman, you fish where you know there's good fish and you just don't throw a line in the middle of nowhere hoping that there's going to be a fish there. But there's a whole bunch of people who are trying to enter the market right now, whether it's their first-time investors or they are experienced investor with a large portfolio. I just want to talk about, options to get into the market right now. We'll just go to break before I'm back in a moment.
Whether you're a seasoned property investor or about to buy your first property, finding the right investment property to buy in 2021 isn't easy. Why do it alone when you could partner with award-winning buyer's agent Paul Glossop? Over the last 10 years, Paul has helped hundreds of clients build multi-property portfolios. Paul's secret is finding off-market bargains that get snapped up before the general public even gets a sniff. Interested? Head to purepropertyinvestment.com today to schedule a strategy call with Paul Glossop.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm with OpenCorp's director, Matt Lewison, chatting through why you shouldn't wait out a property boom. Now, the reason why prices are so hot at the moment is that there's a lot more buyers than what there is sellers, Matt. So, which makes it complicated to actually, number one, identify good assets, but then number two, secure them. What are the best investors doing right now if they're looking to capitalize on investing? And what sort of tactics would you be deploying right now to make sure you get in the right stuff?
All right. So we've talked about obviously where you might how to identify where you might want to invest. And obviously there's a lot of data. We won't go into all the data on all that stuff today, but there's a lot of tools that you can use to be able to identify those areas. But then once you want to actually acquire a property, as I said, it's really hot and heavy right now, which makes it a lot easier. In some contexts, it's a lot easier for somebody who already owns a property, who's built up equity and they're benefiting from equity growth, because they've got a little bit more room to move sometimes on price. Now, with that being said, so once you've identified a property and you want to go and invest in it, we actually try to avoid auctions, to be honest. I know a lot of properties in Sydney and Melbourne, particularly established, go to auction. I will always sell at an auction, but I'll try to avoid ever buying at an auction. And the reason is, I know when I'm a seller, I'm going to get the absolute best price I can get on the day and milk everything out of whoever's there to get the best price. But when I'm a buyer, I don't want to be getting milked and paying more than anybody else was prepared to pay for that property. So we tend to focus on properties that are private sale. We go for properties where we believe that there's extra value that maybe is getting missed by the seller, and we want to be able to act quickly. So get all of your ducks in a row. So if I'm talking to whether it's a first-time investor or somebody who's duplicating, get as much of the groundwork done on your finance as possible so that on the day you turn up to negotiate, you can make it really quick and easy for the seller and turn it around super quick. That's going to improve your chances of getting the property at a good price.
So this whole idea of sort of options to get into the market right now, I understand you guys are doing a fair bit of work on that right now. You got something coming up, a webinar looking at this. When's that on, mate? Do you know?
No, so that's a Cam and Boz webinar. So I wasn't briefed on that one, unfortunately.
Okay.
But
No worries.
I know that the guys have been working hard on it, and we'll provide that detail. So
absolutely. We'll make sure we get that up. I know those guys love talking about that sort of stuff. So to put something like that together, they must lean on you and say, all right, Matt, we need the numbers. Like, how do where do you start and stop when you're looking at, what are the key set of numbers that you need or factors you need in order to make good assumptions based on your MAP process?
All right. So we pull data from the ABS. So we actually get it. We've got a tool set up so that as soon as ABS data is published, we press a button and it sucks all of the data we want into our spreadsheet. And we're looking at things like the unemployment rate. We're looking at things like population growth, interstate migration, which obviously is a different driver to overseas migration. Interstate migration tends to lead to faster buying decisions. Overseas migration leads to an increase in rental pools in certain areas. We're looking at wage growth. We're looking outside of those numbers to actually be in touch with developers, for instance, and monitoring development activity to see who's bringing sites to market and how much stock's going to come through, what's under construction, building starts, and finance approvals as well. So we're really monitoring as much of that as we can, as well as vacancy rates and rents, what's changing in rent. So obviously, an investment decision you make in property isn't about buying something to make just a quick investment and turn it around and sell it tomorrow. You're going to be holding it for years. So what's going to happen in the future is more important than what happened in the past. And you probably noticed one thing I didn't mention at all was the median house price. I actually don't look at the median house price historically for a suburb and the growth in making a decision about where I'm going to invest for that suburb, because I don't care what happened in the past. I care what's going to happen in the future, and making a decision based around, I guess, the influences of the future price growth or future rental growth is far more important for me in that scenario.
You know, you do this for a living, so you're quite sort of familiar with and in control of the numbers and know where to look if you don't know something, or to pull in some sort of, to make a sort of an assumption or a decision on something. For those people who don't have that skills and experience, it must be an absolute minefield for them to get that same advantage.
And when I do attend like client nights or webinars, and often we get questions from people who are maybe numbers driven saying, where do I start? I want to get my head around the numbers. There's some, I guess, key resources. Obviously the ABS is one, but there's just hundreds of different reports that you can get. And within any report, even population, there's different versions of the same report. Some of them are trends versus actual. Then they're broken down into different categories as well. So it can be a bit of a minefield. And I guess that's why there are advisors like us that are out there to help people to bridge that gap and provide as much of it in a focused manner as possible. SQM do some great stuff with vacancy rates. You've got CoreLogic that produce a lot of really good information and insights. In fact, some of the economists working for banks, as well as SQM and CoreLogic and others that provide regular reports as well, they try and provide not just the numbers, but they try to contextualize it for the audience. And when I started out, that was kind of where I went. I was always kind of numbers focused, but I needed to get not just the numbers, but the commentary that goes around it so that I could make sense of it. And after a while, you build more of that mental map of how do all these things interact, and are there things they're missing if they're oversimplifying it that I need to get for myself.
Someone that's been investing for quite some time and then also in the business of supporting property investors to invest, what's your sort of gut instinct and feel towards this current market? Everyone's talking about being a hot market and the whole of Australia booming rather than just some locations. You've seen a couple of market cycles now. Is this what you would have expected at some point in time to happen? How do you make sense of it all?
Yeah, I mean, Cam and I wrote a book, in which I think we published in July last year, saying it was it's called The New Normal. We're investing in the new normal. And it was about COVID and what was likely to happen afterwards. And I guess doing our historical analysis, looking at how do governments respond to economic shocks, how does population change, all those sorts of things, how do people respond to changes in interest rates and borrowing costs, and also getting through turbulent times like post-wars and so on. We forecast that it would be a very strong boom for 2 to 3 years after the lockdowns ended. So I wouldn't say it's a surprise to us. And I'm not just saying that because I want to blow our own trumpets to say, hey, we got this right, because there's a lot of others who have done the same work we did and they came to the same conclusion. And that is that there's 3 drivers to property prices: supply, demand, and affordability. And when you see affordability improving, such as when interest rates drop substantially, then people can afford to pay a lot more for the house. So there's obviously upwards pressure on price, provided that there is not an oversupply of housing in certain local markets. So, yeah, I mean, I think the more you're in it, and I'm not one of those people who just thinks the market's always going to boom and there's never a soft patch. I'm fairly conservative at most times, but this was one of those windows where I thought, after doing the work, it's hard to imagine that prices won't go up substantially when borrowing costs for somebody paying a mortgage have dropped by 40%. And you go, well, 2 people turn up, one a year ago and one today. One of them's got 40% lower interest rates. They're, of course, going to be able to spend a lot more on the property than the person who paid for it a year ago. So, yeah, it should be no surprises there.
Yeah, and some of the comments coming out, 25% increase over the next to 2023, right?
Yeah.
So they're good numbers if you're investing in property. And, you know, the sooner you invest, I guess, the more upside you have in realizing that growth. You know, it's always hard to pick a market. You don't want to be investing at the top of the market, but I don't know many people who have always invested at the bottom of the market. It's very hard to call the bottom. It's only in hindsight when you can do that. But is it already too late for people? Like, should have people been reading your book back in July last year saying, This is when, it's counter-cyclical investing, isn't it? When everyone was talking about doom and gloom in property, there was a handful of people who had some sense of reason to it all and considered sort of narrative and opinions around it. I'd like to think smart property investment included as part of that. Is it too late to get in?
It's a good question. I certainly don't think it's too late. There's still a lot of runway ahead. I mean, the headwinds that we may have later this year potentially will be more regulation on lending practices. And if we look at what that means for instance, as an example in New Zealand, where they increased the financial regulator increased the amount of deposit that banks must take from a borrower before they lend them money. So for us, obviously at the moment in Australia, you can borrow up to 90%, or many borrowers borrow up to 90%. Some are a little bit more, which means they've got to come up with 10% for the balance of the purchase plus about 5% for stamp duty. So later this year, if the financial regulator, APRA, it is for Australia, starts to increase the deposit required, then that's going to obviously mean that there's fewer people who can get into the market. So what does that mean? Well, it may mean that now is a window of time that you may want, if you're trying to get into the market for the first time, you may want to capitalise, because it's certainly not an expectation that those changes will result in a softening of prices later this year. It's just that it will be harder for people to get into the market, and hopefully APRA is hoping that if they were to do that, then it would take away some of the speed of price growth, but prices would continue to go up because of the affordability. So certainly there's still a window of time for people to be getting into the market and capitalising on that. Now, we talked also about the affordability mark, and different cities have got a different, entry point. And I guess one of the things that we identified a few years ago was that there's a lot of people that miss out on being able to buy an investment property. OpenCorp's got over 70,000 people who have inquired with us about buying investment property over the years. And the vast majority of them in our assessment, they actually couldn't get into the market, or still can't get into the market because they had insufficient funds from either a serviceability perspective, as in how much income they make, or also obviously a deposit perspective, which is why we went and started a new fund called Resi Fund that's a property investment portfolio that's ready-made. So when an investor comes along and they say, I've got 10 grand, I want to start in the investment property market, they obviously can't go and buy a house on their own just yet. They may not qualify for a loan. They can invest in Resi Fund, and there's a few other products like it now that have popped up that allows them to get a share of an existing portfolio. They're getting a share of the rent that's coming through, and they're getting a share of the property capital growth.
Yeah, I was going to ask you about Resi Fund, and there is a number of instruments like this now available for those who can't have direct property. Let's get into it, but I'll just go to break beforehand. Back in a moment.
Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
Welcome back, everyone. Phil Tarrant with Matt Lewison from OpenCorp. Now, Resi Fund, there's a whole bunch of different names for it, and there's different sort of offerings out there. But most Australians, if they have superannuation, already have some exposure to property, a lot of it commercial property. And a lot of people with super funds, retail funds or industry funds, don't actually know. But your sort of large superannuation funds own a lot of the commercial properties, and therefore we will have exposure to commercial property. That's why you're wired. But on the Smart Property Investment Show, we talk about direct investment in property, as in you own a property, or you're obviously in it with the bank. But what you're talking about with the Resi Fund is that allows you to be a property investor, but you don't own direct property. You club up with a whole bunch of other investors to acquire assets. How does it work? How big is the fund? How many sort of different assets are within it? And is there many funds within funds, or how does it all work, man?
So we've got about 40 tenanted properties that are generating rent now. Some of them are still under construction. So that obviously if we're building something, when it's complete, it gets rented out. As it starts generating income, that gets shared with all of the investors in the fund. So if somebody invests in the fund and there's a couple of hundred investors, you're one of a few hundred, but you get a share similar to if you invested in a company on the share market, where you get a share of the future earnings of that business. And obviously the unit or the share price may go up over time. So obviously the share price on a listed stock exchange is dictated by people wanting to buy or sell the shares. The share price in a managed fund like Resi Fund is dictated by the asset value. So it's not a listed sort of exchange situation. They have a unit price that goes up when the capital value of the assets goes up and so on. So it's kind of like they're stepping in, they're getting a share of the existing assets. And as we bring in new investors and more money goes into the fund,
buy additional properties. And with those properties, obviously the goal is to generate additional income and additional capital growth for our investors.
So is it easy to trade in and out of the fund if you want to sort of take your money elsewhere?
So we do say, obviously, when somebody's investing in property, whether it's Resi Fund or buying a property, that it's a medium to longer term investment. So if people do wish to exit the fund, we can buy back their units. Obviously, we do that on occasion when the fund is liquid. If somebody needs to exit the fund, the ultimate goal is that it does get listed on the stock exchange in a few years' time once there's obviously a larger portfolio. And we're obviously working towards that, which Australia doesn't have at the moment, a way for somebody to invest in the residential market in Australia on a listed exchange, whereas overseas it's very common. In fact, some of Australia's biggest funds, like Australian Super, invest in residential property in the US through other managed funds and so on. So it's obviously creating access to the residential market for people starting with $1,000.
And this is sort of, it's growing in popularity in Australia, this sort of build to rent type of scenarios where it becomes a lot more institutionalized, where, because residential property is normally been sort of a mum and dad type of enterprise. You've got a number of large developers, but most properties held by smaller investors and also owner occupiers. So this is where what will happen is that larger institutions will build developments or suburbs and rent the whole lot out, right?
Pretty much. And a lot of the groups that are doing it, like the institutions that are working on it at the moment in Australia, like the Mirvacs of Australia, are really focused on the high, like large buildings where they're putting up 200 to 400 units and they can achieve scale, which obviously long-term, that's what's worked in the US. But what we also have found is the smaller scale, the grassroots investment actually tends to generate better yields as well as better capital growth prospects at the moment. So that's where our focus is. Now, if I look at the wealthiest property investor in America is a guy by the name of Donald Bren, and he built a whole suburb and he retained about 30% of that suburb as it was being built. So many people would have heard of Orange County. So he built a lot of Orange County. I think it's called the Irvine Company or the Irving Company, which owns a lot of that land around there. But his, I guess, belief is that as he builds the suburb, if he retains a certain amount, then any work he does to create a new park is adding value to all of the properties he already owns. So I guess that's long-term where we see, I guess, property investment getting to within Australia, but it's a long way to get there. Whereas focus for us at Resi Fund at the moment is to have a diversified portfolio. So we've got assets in Melbourne, in Perth, in Brisbane. We're looking at investments in Sydney at the moment. So somebody investing in Resi Fund gets a share of, I guess, what we would consider a slice of the Australian property market, focused around the capital cities using our market area property approach to kind of eliminate the underperforming assets.
Good. Well, it sounds like a smart play, mate. I look forward to hearing more about it and how it all goes. Appreciate your time, mate. I always enjoy the discussion. We sort of get into it and I feel a lot more informed as a result of it. Matt Lewison, Director, OpenCorp, thanks for your time, mate.
Awesome. Thanks, Phil. Really appreciate it.
Nice one. I hope you enjoyed that, everyone. Remember, smartpropertyinvestment.com.au. Social media, if that's how you like to get your info. You can find us at Smart Property HQ. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.